this wonderful chapter Ind AS 32, Financial Instrument. There are three standards dealing with financial instruments. Which are these three standards? This topic is so vast, they have divided the whole concept of financial instrument into three standards. Ind AS 32, which deals with presentation. So it will be basically focusing on the liability side. Which item should be shown as a liability and which item should be shown as an equity. Whether preference share is a liability or equity. Is it right? Whether a convertible debenture is a liability or equity or partly liability, partly equity. That is called presentation. Then in this standard we will also deal with, can financial asset and liability be set off? Can financial asset and liability be set off? And how will you present income or expenditure relating to financial instrument in P&L account? 107 deals with disclosure requirement. So all the disclosure requirement they have set out in 107, but the main standard is 109, where we will discuss recognition principle, derecognition, classification, measurement, impairment and hedge accounting. So this is our agenda for the next few days. Under Ind AS 32, we are going to learn how to identify equity and liability, whether equity and liability can be offset in the balance sheet. Under 109, we will see recognition, derecognition of financial asset and liability, their classification, measurement, hedge accounting, and Ind AS 10C is only dealing with disclosure part. So today our topic is Ind AS 32. So please come to Ind AS 32. What are the three main objectives of Ind AS 32? First, it will help you to identify whether the financial instrument is a financial asset or financial liability or equity instrument. Accordingly, they will be presented. Then in the P&L account, whether an income or expense will be shown as interest, dividend, losses, gain, or will it be shown in SOCIE, and then the standard will tell you when should you set off financial asset and financial liability. The most important thing is understanding the definition of financial instrument for the time being. The name of the standard is financial instrument. Every word is important. A financial instrument is defined as any contract. It has to be a contract, an agreement which is enforceable by law. It can be oral, written or implied, and that give rise to financial asset of one entity. So for entity A, it is a financial asset, but for entity B, for the other entity, it should be either a financial liability or it can be an equity instrument. If these conditions are satisfied, then it is a financial instrument. It should be contract. That contract results into financial asset for one enterprise and either financial liability or equity instrument for the other enterprise. A simple example would be investment in debenture. Investment in debenture made by entity A, issued by entity B, is a financial asset for A, is a financial liability for B. Another simple example, debtor creditor. Debtor is a financial asset in the books of A, but in the books of B, A is a creditor as a financial liability. Equity share investment, very simple. Equity share investment is a financial asset in the books of A and is an equity instrument in the books of B. Preference share issued by entity B subscribed by entity A, financial asset for E, and it can be either a financial liability or it can be an equity instrument in the books of B. These features make a contract a financial instrument. So as we'll go ahead, we'll see more information about financial instrument. Let us quickly summarize what is contract. Contract or contractual means agreement between two or more parties which has clear economic consequences. Contracts cannot be avoided at its discretion by a party. Contracts can be enforced by the law. That means it will cast an obligation on the parties to honor the contract. Contract can take various forms. Contract can be oral or writing. Contract can be with individual, contract can be with companies, trusts, society, non-governmental organization or government. So the other party can be anyone. The other party can be individual, company, government, NGO, trust. As long as it meets the definition of financial instrument, the standard is applicable. It is mandatory that contract should exist for a financial instrument. So if you have to check whether a particular asset or liability is a financial instrument or not, first we have to check whether there is a contract or not. Whether there is a, like for example, income tax payable is not a financial instrument. There is no contract. It's a statutory obligation. It's a statutory obligation. Gold held by you, you're holding gold, is not a financial instrument. There is no contract. This pen is not a financial instrument. There is no contract. So if there is no contract, there is no question of it having a financial, it being a financial instrument. In case of financial instrument, there are two parties involved. The one party, we will call him issuer of the instrument. The issuer of that instrument will be presenting it on the liability side of the balance sheet. Share issued by a company will be presented on the liability side. But on the liability side, there are two possibilities. Either it can be treated as an equity instrument, then it will be forming part of equity, or it will be forming part of liability. Debenture issued by a company will form part of liability. Equity share issued by a company will form part of equity, and there is another party whom we will call holder of the instrument. That party will always show it on the asset side of the balance sheet and present it as a financial asset. So for one party it is a financial liability, for one party it's a financial asset. Now one example also I have given here. In the books of one party, the other party is a debtor. Debtor is a financial asset. In the books of other party, creditor is appearing. Creditor is a financial liability. Cash is financial asset by default because it is the RBI's liability. Investment in equity share of X. For one party it is financial asset. For the other party who has issued it, it is an equity. Investment in redeemable preference share is financial asset, but for the company, the redeemable preference share capital is a liability, financial liability. Bank balance is our financial asset, but for a bank, a deposit made by a customer is a financial liability. For a bank, deposit made by a customer is a financial liability. Now, financial instrument can be of two types here. One which are called primary financial instrument, and the second is called derivative financial instrument. Okay. So primary means the original, and derivative means they derive their value from other instrument. They derive their values from other instrument. So there is a long list of primary financial instrument. In your book, what you will do, these three items which are printed probably on the derivative column, you shift it to primary column, or you can just mark this as last three primary. Example of primary financial instrument: cash in hand, bank, investment in equity instrument, investment in debt, receivable, bills receivable, borrowing, share capital, redeemable preference share capital, debt, issued bond, other debt instrument issued by the entity, convertible debt, dividend payable, trade payable, bills payable, guarantee given for repayment of debt upon borrower's default. Even that is primary instrument. And then staff advances, security deposit liability. These are called primary instrument. And what are secondary or derivative financial instrument? Derivative financial instrument means they derive their values. They derive their values from underlying instrument. Like popular example of derivatives are call option, put option, forward, future, swap. A derivative can be an asset also. A derivative can be a liability also, or it can be a derivative equity also. We will see all this in the coming part of this chapter. And then there are hedging instruments. Derivatives are used as hedging instrument also. So our scope of work deals with doing accounting of these items. Okay. Then in the exam, suppose they ask you whether land is a financial instrument, whether gold is a financial instrument, whether tax payable is a financial instrument. So you have to apply the definition of financial instrument. It should be a contract. It should give rise to financial asset to one party, financial liability and equity to other party. Okay. So I have made a small list of items which are not financial liability, financial instrument. And in bracket we have written the reason also. They can be asked as a separate question for 4 marks. They will give you, let's say, 10 items, and you will be asked to identify which of them is financial instrument and which of them is not. So whether plant property and fixed assets are financial instrument? No, because there is no contract. Intangible asset? No contract. Capital WIP? No contract. Intangible asset under development? No contract. Investment property, land and building, bracket right? No contract. Prepaid expenses? Oh, contract exists, but it is not a financial asset. Why it is not a financial asset? Because there is no contractual right to receive cash. Because a financial asset means you have a contractual right to receive cash. That is missing. And then inventory, no contract. Provisions, no contract. It is a present obligation. Then we have provision for income tax is a statutory obligation. Deferred tax is not a contract. Deferred revenue is a contract, but it will not be settled in cash. It will be settled in goods and service. So it is not a financial liability. It does not fit into the definition of financial liability. Then next is warranties. Warranties also write down same as above. There is a contract. There is a contract to repair or replace, but it is settled in goods or service, not in cash. Then gold and other commodity, no contract. Biological asset, no contract. Advances for goods, contract exist, but will be settled in goods, so not a financial liability. It has to be a financial liability for one party. It's not a financial liability because settlement will be by delivery of goods. written. Now we'll quickly look at the scope of the standard. Not important for exam. It is scope paragraph, but the last executory contract part is important, which I will explain. So what will come under the scope of the standard? Will not come under the scope of the standard. Indemnification asset. Already we have covered in Ind AS 37. Assets which you will recover from other party in case of loss. Then rights and obligation under employee agreement, Ind AS 19. Share based award, Ind AS 102. Now this point underline D, if you have investment in subsidiary, associate and joint venture, and if you are recording them using cost model, Ind AS 27 will apply. Then agreement for business combination, forward contracts are out of the scope of the standard, but deferred consideration payable in business combination is in the scope. We have to record them at present value. Do you remember present value, deferred consideration? Insurance contract 104. Contract assets and liabilities which are covered by 115 will be accounted there. Lease receivable and lease payable at the inception, at the beginning, will be accounted under 116. However, subsequent treatment will be as per Ind AS 109. Similarly, if there is any impairment of lease receivable, that will be covered by Ind AS 109. Certain loan and financial guarantee contract which are covered by Ind AS 104 will not be covered by this standard. Okay. And now you tick mark important. Certain executory contracts. Executory contract means these contracts have not been executed by both the parties. Some executory contracts are in the scope of Ind AS 109. So in the next few lines we will see. Usually executory contracts are outside the scope of the standard. But in some cases, executory contracts are covered by the standard. Now what do you mean by executory contract? Executory contract means usually to buy and sell non-financial item. I have placed an order to purchase wheat after 3 months. So that is an executory contract which is intended for usage requirement of the entity. Why I have placed an order to buy wheat after 3 months? I need wheat. I have a business of making bread. Okay. So I need wheat. So I have entered into a contract to buy wheat after 3 months because I wanted to ensure I should get a timely delivery and the price also. But what is my main objective? To use it in the business. The standard says if you have entered into a contract to buy non-financial asset like steel, milk, paper, wheat, okay, cement, copper, for your business usage requirement, then the standard is not applicable. Okay. Then the standard is not applicable. But suppose I have entered into a future wheat contract to make profit from that, then applicable, because then it is a derivative. So if you have entered into an executory contract for non-financial asset, first apply past practice test. What is past practice test? It means how you have settled those contracts in the past. If the history of the entity is that it is settling such contract in net cash settlement, that means their intention is not to take the delivery of wheat, steel, cement, copper. They are only betting on the price movement. If you are betting only on the price movement, the standard says it's a derivative. It's a derivative because you are settling on net basis. So it is not actually a genuine contract to buy underlying goods, but it is a contract to make profit. Then you will say, no, I don't settle on net basis. I take the delivery. But what is your past practice? The past practice is that immediately after taking delivery, you resell it. You resell it. You don't use it. The moment the delivery comes, price has gone up, you sell it or whatever. So if you purchase it also with the objective of immediately reselling it also, then also it is in the scope of this standard, it is like a derivative only. It is like a derivative. So either you settle on net in the past, or you have the history of making short-term price movement gain by buying and reselling immediately in the very short period. This will be treated as a derivative. This will be treated like a derivative. The standard will become applicable. Test number 2. Suppose you don't have past history of net settlement or buying and reselling in short notice. Then check whether the contract permits net settlement. If yes, whether the entity intends to settle on net basis. Contract permits net settlement. You are a farmer, I am the entity. We have agreed either you deliver wheat or you pay me the price difference. And I also intend to take the price difference. Then it will come under the scope of 109. Other contracts are out of the scope of 109. And the last point is contracts which are within the scope are treated as derivative contract, either future or option. One more point. If a contract can be settled in net basis, if contract is allowed to be settled on net basis, entity on its own can designate it as derivative for the purpose of this chapter. If a contract can be settled on net basis, then there is an option given to the entity, they can apply Ind AS 109. Or even if it is not settled on net, but it allows net settlement. So when will contract for non-derivative asset or non-financial asset be covered by the standard? I repeat, 1, there is a past practice of settling on net basis. Second, there is a past practice of buying and quickly reselling so as to make immediate profit. Third, contract permits net settlement and the entity wants to settle it on net basis. And fourth, the contract permits net settlement and the entity chooses an accounting policy of Ind AS 109. In other cases, contract for non-financial instrument are outside the scope of this standard. Is it right? So now we will continue tomorrow.